American shale is a risky business. It's a cutthroat industry that is entirely cyclical in nature and vulnerable to the whims of the OPEC Plus oil cartel. But still, plenty of bulls are certain there will be a second shale boom. The first shale boom took nearly everyone by surprise, including the industry itself. The second one will be different. It won't entail a bunch of drillers racking up copious amounts of debt and spending money as if it were free. It won't, by all indications, be a free-for-all that ends with corporate carcasses strewn across the Permian Basin. Lack of cost discipline, a looming EV revolution, a new green agenda in Washington, and divestment crusades are the most cited causes of shale's apparently impending doom. But fossil fuels won't die a sudden death. It will take far longer than many believe to truly transition away from oil and gas, if ever. In the meantime, prices and demand are both rebounding, with shale the clear beneficiary. During the last boom cycle, shale saw massive growth for two reasons. Oil prices soared above $90 per barrel, and interest rates were low, giving shale access to capital. Today, even though oil isn't at $90, interest rates are low, and the conditions seem to be ripe for another shale rally. The shale industry may never again drill wells at the same breakneck speed it did in the first boom, but things are more efficient now, and it doesn't need to. In February 2014, at the height of the shale boom, new well oil production per rig in the Permian was 96 barrels per day. Fast forward to February 2021, and new well oil production per rig is 1,142 barrels per day. Today, they don't need as many wells to pump the same amount of oil. Production in February 2014 was just over 8 million barrels per day. Today, amid the pandemic, U.S. oil production averages 10 million barrels per day. Yet in 2014, there were more than 1,400 rigs drilling for oil. Today, there are just 310. That's because new wells average nearly 12 times what they did 7 years ago, which also means that costs are significantly reduced. That doesn't mean U.S. shale will ever again see the 70% gains it saw starting in 2012 when it went from producing 5.8 million barrels to 10 million barrels in 2018. Demand forecasts do not support that. But as OPEC Plus continues to restrict output and demand continues to rise, a door is opening for a much more efficient version of American shale. That is, if they can manage to refrain from drilling themselves out of another boom.